Well, good morning, good evening, good afternoon, depending on where you're attending this webinar from. My name is Alex Kanyi, and I'm a partner at Cliff Decker Hoffmeyer in the Nairobi office. So today we are here to discuss about Kenya's draft medium-term revenue strategy. And of course, we are joined by none other than Maurice Oray, who is the Deputy Commissioner for Corporate Policy at the Kenya Revenue Authority, who will be doing a presentation shortly about the draft medium-term revenue strategy. Just for some housekeeping rules, we expect the session to run for about an hour. I'll do a short introduction, followed by the presentation, and then at the end we'll have a session for Q&A. Because the session is quite short, we may not be able to answer all the questions, but we'll attempt to answer most of them, and then we'll see if we can take more questions. So, Karushka, maybe you could go to the first slide. Great. So even as we speak about the draft medium-term revenue strategy, we thought it would be important, especially for every one of you who has any tax obligations here in Kenya, to also consider the tax amnesty program, which I'll just speak about it for a minute or two. So we could go to the next slide. So our office is based in Kenya. Just the previous slide, our office is in Kenya at Merchant Square, Riverside Drive. We have 8 partners dealing with different practice areas, myself dealing with tax and exchange control. We have Sami, Njeri, and Martha dealing with corporate M&A, private equity. Njeri also does a bit of employment. We have Desmond, who leads our dispute resolution practice. We have Clarice, who leads our environmental law practice. We have Lydia, who recently joined us and leads the real estate conveyancing practice. And of course, we have Shem, who leads our TMT, intellectual property and data privacy practice. Our firm just last year won the first runners-up of the large law firm of the year at the Nairobi Legal Awards. And our partners are highly ranked, in all the legal directories. Next slide, please. Great. So just to mention something small about the tax amnesty program, which was introduced through Finance Act 2023 here in Kenya. It's one of the programs that our firm, CDH, championed for right before the bill. And we championed for this because the voluntary tax disclosure program within our tax laws was coming to an end, and we thought that the Revenue Authority had some success around it, and our taxpayers who actually took advantage of it, with the Revenue Authority collecting in excess of 10 billion Kenya shillings. But considering that it was coming to an end, we thought that it's something that the Revenue Authority could still consider, and I understand they're targeting at about 50 billion Kenya shillings with this particular amnesty program. And the good thing about the program is that for taxpayers who've paid their penalties and who have paid their principal taxes up to the 31st of January 2022, these taxpayers can then enjoy an amnesty of the penalties and interest, provided that principal tax is paid up to 31st December. And if you'd already paid the principal tax, what we understand is that the Revenue Authority will then quickly look at their system, clean up their ledgers for those particular taxpayers, and basically take away the penalties and interest that would be perhaps sitting on your iTax. But for any other taxpayers, especially those who would not have cleared up their tax liabilities, their principal tax by the 31st, who have not paid their principal tax by the 31st of December last year, what they can do is then apply for the amnesty program, and provided they pay the principal tax by June 2024, what we understand is that the law has provided that they will be forgiven, if we would say, for their principal, for their interest and penalties. But you need to apply for this amnesty program, engage the Kenya Revenue Authority, which is something we are happy to assist any taxpayers who would want to clean up their ledgers and pay their principal tax liabilities by June 2024. We can move, skip that up to the draft MTRS, the 10th slide. Great. So, and this is really where we are today around the draft medium-term revenue strategy. And like I mentioned, we have a guest speaker in the name of Maurice Oray, who is the Deputy Commissioner at Kenya Revenue Authority in charge of corporate policy. This particular MTRS, the concept really, as we know it, started from the year 2016. And the purpose of this particular strategy is to ensure that the government increases its tax revenues over and above increasing the tax to GDP ratio. And then I'm sure Maurice will speak about this a little bit more. Next slide. The next one. Well, under our constitution, that's where the government gets its basically its right to impose taxes under Article 210 of the Constitution of Kenya. But even with this particular right, we have the laws surrounding taxation in Kenya, but more importantly, you have the Public Finance Management Act, which then mandates the National Treasury to formulate, implement, monitor economic and financial policies. And I believe it is through this and other laws that then we have the MTRS getting anchored, with Kenya Revenue Authority and National Treasury being some of the key players. And in 2022, the government shared a circular, the National Treasury shared a circular, where they mentioned the intention to develop Kenya's first medium-term revenue strategy. And the intention is actually long-term, to look at from 2024, 2025, up to the year 2030, to align this with the Vision 2030. So what we have now within the country is the draft medium-term revenue strategy covering financial year 2024, 2025 to financial year 2026, 2027. And Maurice will be speaking about this shortly. Next slide. Kenya is not trying to do this alone. The other countries, developing countries, who are also trying to develop their own revenue strategies. I was reading a paper by Peter Mullins, who is a former chief at the IMF. And in this particular paper, he was analyzing the successes of the MTRS in Uganda, Indonesia, and Papua New Guinea, and Kenya sits right there in terms of developing countries who are also trying to achieve their revenue targets through a medium-term revenue strategy document. But key things that he mentions there, and which I agree with, is that there's need for this particular MTRS to go from just developing one to actually implementing it. Need for very strong political will and leadership for this to succeed. Of course, involvement, stakeholder participation, call it the taxpayers, civil society, businesses, there's need to engage. And of course, we need to also ensure that whatever we have within the policy is then realistic and helps to spur economic growth. So with that, let me welcome Maurice Oray from the Kenya Revenue Authority, who will give us a presentation about this MTRS and basically give us some insights around the reasoning that the government has on this. Welcome, Maurice.
Thank you, Alex. And hello, everybody. Yes, as you have heard, my name is Maurice Oray. I'm the Deputy Commissioner and Head of Tax Policy at the Kenya Revenue Authority. I'll take you through the draft medium-term revenue strategy for Kenya. As you are aware, the draft document has been circulated for public comments, and I think the closing date for public comments has actually passed. We have received quite a number of comments from the public which are under review, and we expect to incorporate this in the final document that will be submitted to the National Treasury, to the Parliament, not National Treasury, to Parliament for review and concurrence. So today, I've got to say that I'm glad to be part of this engagement, and my brief is very simple. I'll take you through the contents of the draft medium-term revenue strategy. And in terms of focus, I'll focus on the following areas. Please just go down to the next slide. We look at the objective of the MTRS. Let me use the term MTRS going forward. That is medium-term revenue strategy. I'll look at also the policy measures that have been put in place in terms of the various taxes. That is income tax, excise duty, VAT, and also other taxes that we levy. I'll also focus on the levies and non-tax revenue. Then the other thing I'll touch on is on the revenue measures that have also been put in the medium-term strategy. Then we look at measures that we are putting in place to ensure that there's compliance improvement. I'll finally talk about the stakeholders, the critical ones that are going to ensure that we have successful implementation of the MTRS. Next slide. So straight into the presentation, I'll look at the introduction. And as you are aware, the medium-term revenue strategy as MTRS is a comprehensive framework for tax and administration reforms aimed at boosting domestic revenue. The aim of the strategy is meant to mobilize additional resources for implementation of the government agenda of better. Better in full is bottom-up economic transformation agenda. The strategy, as had been mentioned earlier by Alex, is aimed at raising the tax ratio of ordinary revenue to GDP to 20%. As you are aware, like any other developing countries, the tax GDP ratio has remained largely very low for Kenya. Actually, for the year just ended, this ratio was actually below 15%. And our intention is that by implementing the strategies that are outlined in this draft document, we will push it to at least 20%. I wish also to say that this is a first MTRS, and it covers the period 2024, 2025, up to 2026, 2027. The medium-term revenue strategy is in two phases. The second term now will cover the period 2027 to 2027, 28 to 2029, 30. Next slide. Next slide. Oh, okay. Yes, the next slide is on objectives of the MTRS. And the first thing I told you that our tax GDP ratio is very low. Actually, as at for the year ended 2022-2023, it was only 13.5%. And we aim to raise it to 20% by end of 2026-2027, because that will mark the end of our first term of MTRS. The MTRS is also aimed at promoting investment by removing market distortions in the tax laws, specifically the issue of rationalizing tax expenditure, as well as reviewing the tax rates, which many people have said that our tax rates are too high. We'll see how this is proposed in the MTRS as we move along. One of the other things that we need to address is the tax compliance, which generally has remained very low at 70%. And our intention is to increase it to 90% by the end of the first term of the revenue of the MTRS, that is 2027. Also, the other objective of the MTRS is to align tax policy with other government priorities. Next. Yes, now we go to specific policy measures, and we'll start with the measures on income tax. The first measure is that we intend to reduce the corporate tax rate of income from the current 30% to 25%. That will be during the strategy period, and the strategy period, as I said, is between 2024 and 2027. So in the first term of the revenue of the MTRS, we expect that we take the rate to a lower rate of 25%. We also intend to align withholding tax rates applicable to income earned by the non-residents with the corporate tax rates. Aligning means that it's not that we are going to make it equal to the corporate tax rate. It means that we are going to rationalize it so that it reflects the reduced tax rates for corporate bodies. We also, in the MTRS, we propose to phase out preferential corporate tax rates while focusing on other investment promotion measures. One thing you note that is the Income Tax Act, as it is, has so many multiple tax rates, and some of these are put on to promote investments and also to give some incentives to certain sectors of the economy. But with the reduced rate of 20%, we expect that if implemented, the MTRS will phase this out. On residential income tax, we also intend to review the income taxes for residential properties, and in particular, we have proposed 3 options: to allow expenses, retain the simplified rate that is existing now, or to kind of propose a scenario whereby we allow a portion of the expenses, say 40%. Again, under the MTRS, draft MTRS, we are proposing to review the exemption regime to ensure that it's more efficient and it's pro-investment. We intend to reintroduce a minimum tax. I believe you are aware of the introduction that we did, and which unfortunately was overturned by the courts. But the MTRS proposes that to reintroduce the minimum tax. To ensure progressivity of the individual tax rates, of the individual taxes, we also expect to review the tax bands. for the individual taxes. The other proposal in the MTRS is to review the pension tax structure, which currently, as you are aware, is based on the concept of exempt tax. And we propose within the MTRS to change it to exempt. I hope we understand those terms, but simply means the contributions are exempt, the investment scheme are exempt, and also the distributions or the withdrawals are exempt. So that is the exempt. Review pension structure, that one I've said. Review and rationalize exemptions on personal income. Yes, the exemptions that are provided on personal income, including reliefs, personal reliefs, insurance reliefs, mortgage reliefs, and many other reliefs that are provided in the current regime. We expect to phase this out within the medium term. Next slide. Yes, now on VAT. Now, the current threshold of VAT, which you are aware is at 5 million Kenya shillings, has been there for quite some time and has not taken into account inflation and time value of money. So we expect that this will also be reviewed within the first term of the medium-term revenue strategy. We intend also to review the VAT rates, and here I need to make a few clarification, because I think there is a lot of misconception or misunderstanding on what we mean by reviewing the rate. In the MTRS document that you may have read, when we mentioned that we'll harmonize with the other East African partner states, some of us interpreted this to mean that we'll increase the VAT rates. Far from it. We know that most East African partner states have a VAT rate of 18%. When we say we harmonize, doesn't mean that we are going to increase the rate to 18%. We may increase it, or we may even reduce it. So please have that clarity, that harmonizing doesn't mean that we put it as equal. Harmonizing doesn't mean that it will be equal. Harmonization includes even the issue of base for VAT, and even the list of goods that may be exempt or zero rated. So just to make that clarification, that reviewing the VAT rate doesn't mean that we increase it. Also on VAT, we intend to introduce VAT on education services provided by schools. And here, note that we have said schools, not private schools. Provided by schools which are not directly related to education. I know this one has generated a lot of debate also, but just for clarification is that we are not targeting private schools, and we are not targeting essential educational services. It is only the extras that are provided in schools, like swimming pool and many others that are not ordinarily available to ordinary people, that is, for example, in public schools. So the way this will be done, it will now be designed in the law. The other issue that the MTRS proposes is to review the VAT exemption and zero rating of supplies. Basically, to align the VAT system to, first of all, destination principle, and also to align with international best practices. When we talk of international best practice, actually, we are saying that under what circumstances are supplies zero rated, and you'll find that it's basically on exports. Of course, there will be a few exemptions, like maybe raw materials, or no, raw produce from the farms, and also maybe where there are diplomatic arrangements between countries. Now, the other thing that also we intend to do within the framework, which has been proposed, is to review the input VAT apportionment formula. Those people who are familiar with this, you note that that apportionment formula provides that if your supplies, taxable supplies, is within a certain threshold, then you're not required to use that formula. But it's something that we have looked at, and we intend to review it to ensure that it is productive in terms of taxes. Again, here there's a lot of misconception because some people are saying that we are going to remove the formula. The formula is not going to be removed. It is only the threshold that is going to be aligned. Then next slide. Yes, the next slide is on excise duty policy measures that are in the MTRS. We intend to continue imposition of excise duty to address negative externalities and also to generate revenue. And these policy measures will include review of the excise duty on petroleum products to fully address negative externalities. As it is, we have noted that this is not the case. In most cases, we actually fall short of addressing the negative externalities, and this will be done in line in agreement with the other EAC partner states, and that is already ongoing. We also intend to introduce excise duty on coal. You may be aware that we don't produce coal as at now, but we import coal. Quite a number of industries do. And also we expect that in the near future we'll also start producing coal. And of course, coal has negative externalities, and we need to address this. We also, under the MTRS proposals, we expect to review the basis of taxation of alcoholic products by now basing the tax on the alcohol content. This, you may be aware that we are actually doing this as at now, but we are using so many parameters. So we want to ensure that the alcohol content remains the main parameter to be considered in terms of taxation of alcohol. Also, the tax regime for excise duty on sugar, we are also going to review this and base it on the content, the sugar content of the non-alcoholic beverages. Next slide. Now, on other taxes, there are also a number of measures that we want to put in place, specifically with reference to customs. As you are aware, the rates of custom duty on imports are basically based on regional law. That is the East African Customs Management Act. And if you look at the rates there are very many, starting from 0 to 35%. Of course, there are other rates, particularly on sensitive goods. But these rates actually, they create some classification disputes in particular, and also they create distortions. So our intention, based on the draft MTRS, is to engage the other partner states to ensure that we deal with the issue of multiple rates and change this. First of all, exempt raw materials for capital goods, for production, and also on capital goods to make sure that they are at zero duty, but also to look at the multiple rates and ensure that they are basically between 15 to 20%. That is as far as in customs taxes are concerned. But there are other tax measures that we are also proposing in the MTRS. The issue of carbon tax, this is a major, I would say, global issue that not only Kenya is looking at, but many countries. So under the MTRS, we intend to focus more on the carbon taxes to ensure that we deal with the problems of carbon emission. The other issue that we are looking at is on excise duty on betting. This basically will be to ensure that we fully address the negative externalities. Now, above all this, and this is important to note, in case these measures don't probably lead to certain shocks in revenue, then we may introduce within a very short term a surcharge tax. This one is not mandatory, and I want you to hear that. We may introduce a surcharge tax to address any significant shortfall in taxes that may result from the measures that we are proposing. And you have seen that some of the measures that we have proposed are very drastic, including reduction of corporate tax from 30% to 25%. They might result in significant reduction in revenue. And to ensure that the government expenditure or government funding requirements is met, we may introduce a surcharge tax. But that one is underlined the word may. We, under the medium-term revenue strategy, we are proposing also to introduce motor vehicle circulation tax based on the insurance premium that is paid on for the motor vehicles. And also, we also, in addition to these measures, we also expect to develop a tax expenditure governance framework that basically will deal with the guidelines for giving incentives, exemptions, and any other. Next slide. So I'll now look at the levies and non-revenue charges. And basically, it's a continuation of what I'm talking about. You note that non-tax revenue consists of government revenue received from all other sources, excluding taxes. And this includes investment income, traffic revenue, land revenue, fines and forfeitures, interest, social contributions, as well as an administrative fee charged on services by government. It's important to note that non-tax revenue contributes an average of 0.7% of GDP, with investment income contributing significantly, which is at 0.5% of GDP, followed by administrative fee. Yet these revenues have been performing very poorly. And the reason why they perform poorly in terms of facilitating the government is that there is no coherent policy. Also, they are reviewed after a long time, and the system used for collecting them are semi-automated. So we want to put this also in the MTRS to ensure that we deal with these challenges. Next slide. So what are we going to do on these levies and tax revenue? First of all, on fees, we note that fees imposed on services provided by government entities are either submitted to the exchequer or retained to meet operational needs of the entities that levy such fees. There are problems of transparency and accountability which need to be addressed in the MTRS. There is need to develop a standard criteria, and that is what we'll focus on in the MTRS, which will now ensure that these levies are imposed in a standardized way. And we'll also develop guidelines on the imposition of the same. Also, certain levies that are levied by the government, including road maintenance levy, export levy, petroleum development levy. We now have the housing levy, for example. We note that this kind of levies affect other taxes because they are deductible, for example, for income tax. And what the government will do in the medium-term revenue strategy is to rationalize the imposition of these levies to limit the adverse impact that they have on the other tax collections. Also to deal with the issue of the exemptions that are provided so that they are actually harmonized. Dividend and surpluses. These again are also the other sources of revenue for the government. And the problem that we have, and which we look at in the medium-term revenue strategy, is the performance of these government entities. And what we'll focus on is to improve the oversight of the government entities and also initiate legal reforms, including development of regulations to ensure that the oversight against these entities are effective. Next slide. Still on non-tax revenue, we have put in also administrative measures, which include the strengthening reporting framework for monitoring of non-tax revenue, issue of adopting collaborative approach in the collection of non-tax revenue. You have heard that, for example, that we need a unified collection of government revenue, whichever type. So that will be important for the government. Also, we need to review the government charges every 5 years to take into account inflation and ensure they are commensurate with the services that is received. The next slide. Now, I'll just summarize the revenue administration measures because they are very many. So I might not go through all the administrative measures, but in short, they are basically aimed at improving compliance, improve efficiency in terms of tax refunds, staffing, that is capacity within the tax administration, ensuring tax audits are more efficient, and also to improve on non-tax revenue. And of course, tax administration measures, including information technology, are some of the areas that we are going to focus on as part of the MTRS. Just go through, but I think I'll not have to go through all the slides. I've shared this, and you are free to, you can be provided with this so that you read it at your own time. But maybe just to mention a few, some of these are actually already ongoing, like information technology. I believe that you appreciate the kind of improvement that we have made in this area. The newest, of course, is the rollout of the e-teams that makes it fairly easy for the tax administration, and I believe also the taxpayers in filing returns and making payments. Administration procedures, these are being reviewed both at customs and the whole of KRA. Please move to the next slide. Of course, the administrative measures, as I said, are being reviewed to ensure that we deal with all aspects of our administration. Important to mention in this slide is the issue of the submission to establish a special tax court with relevant tax law expertise to improve the turnaround time of litigation. Most of the taxes are being tied in litigation process, and I think having a special court deal with tax cases will be the right direction to take. Next slide. Still on tax administration measures, the issue of integration with other government systems is also key in terms of the medium-term strategy, and also improving the debt management through various schemes that are enumerated there. Next slide. Still on compliance improvement, the issue of supporting voluntary compliance and collaboration with the taxpayers is a key aspect that we are going to focus on in the medium-term strategy. Next slide. Still on improvement of tax compliance, the issue of tax refunds, I've talked about it, staffing of the tax administration and improving taxpayer audit are issues that we are focusing on in the MTRS. Next. Now, the critical stakeholders that we are looking at here in terms of implementation of the MTRS are the National Treasury, the ministries and departments and other government agencies, state law office, the county government, the legislature, judiciary, non-state actors, professional bodies, private sector, and other development partners. So these are the people who are going to help us in terms of ensuring that the MTRS is a success. Next slide. And ladies and gentlemen, that is a summary of the draft MTRS. Thank you very much.
Thank you, Maurice, for that very good presentation. I think we'll now open it up for questions. If you have any questions, please feel free to type them on the chat box there. And as the questions start coming in, Maurice, where do you see the interaction between the draft MTRS and the national tax policy?
Well, I have to say that if you have read the draft national tax policy and the MTRS, basically the two documents talk to each other, because as you know, the national tax policy basically prescribes the legislative aspect. The MTRS develops the strategies that will be used particularly to deal with tax-based expansion and to ensure that, that we grow the tax GDP ratio, which has been the main problem. Yes.
Okay, so in terms of predictability and certainty of taxes and perhaps introduction of a few taxes in between, did you feel that it's still consistent with the draft national tax policy?
Actually, that is the convergence. That is where they converge. The intention is for taxpayers to ensure that there is predictability in the tax system. And when you look at the national tax policy, it creates the guidelines within which the government can prescribe the tax laws. The MTRS now specifies the strategies that are outlined, which the government should follow. So the convergence is basically on the issue of predictability and certainty in the tax measures. Yes.
Okay. I guess again to just welcome anyone who has questions. We have a few minutes to go before the end of the webinar. So if you have any questions, feel free to type them on the chat box, and we'll have them addressed. As you type the questions, maybe Maurice, what's the next step after this draft MTRS? Taxpayers had a chance to present their submissions by the 6th of October, which is Friday last week. So what are the next steps now that taxpayers have given their comments?
Yes, thank you. As I said at the beginning, the next step is for us to review the comments from taxpayers and then consolidate what will be the final draft. That final draft will be submitted to the cabinet. Then from the cabinet, it will go to parliament. So parliament will basically ratify or approve this. Of course, it looks odd because the parliament job is to legislate, but it is important that we engage them early enough so that when we give them the legislation, we refer them to the document that the government has submitted to them in terms of what the executive is going to do. So it is kind of to get a prior approval on the direction, the general direction which the government is going to take. So the next steps, cabinet, parliament. Yes.
So in essence, we should expect to see some of these measures translate into Finance Bill 2024.
Expect that some of these measures will be in the Finance Bill 2024, correct? Or
okay.
even earlier.
Or even earlier. Oh, interesting. So are we looking at a tax amendment
Yes.
bill sometime? Oh, really? That's news. Okay.
That one is not. It's not a must that there will be a tax amendment bill, but if necessary, then we might get a tax amendment. Yeah.
Okay. All right. So I see Julian Samboko from Nation Media Group asking, so the MTRS mentions the potential introduction of presumptive tax and minimum tax. How does the commissioner see this going, given by the precedent we already have experience with these two taxes?
Thank you very much. And let me answer Julius in some technical language. Any tax that is not based on a definite calculation is presumptive. So, for example, the turnover tax is a presumptive tax because it presumes that if you make a certain level of turnover, then if we do the calculation, the tax paid will be that much. So when you say presumptive tax, it doesn't actually make sense. But the minimum tax is a presumptive tax because it's based on some levels, which is not the what usually happens. Because if we calculate taxes normally, then that will not be presumptive because it's on assumption that anybody with a level of activity will produce a certain level of tax. And presumptive tax can be based on turnover, it can be based on assets, it can be based on even expenditure. So, but to go straight to the question, yes, the MTRS proposes introduction of minimum tax, and minimum tax is a presumptive tax. What we note is that the minimum tax was actually ruled unconstitutional by the courts. And the reason why it was ruled unconstitutional, we have taken note of that, and we are going to address that as we implement the MTRS, so that we don't offend the Constitution again. So Mr. Mboko is asking, how does the Commissioner see this going, given the precedent we have already explored? Yes, we have taken into account the court decision on that, and we'll align ourselves with the court decisions. But again, Mr. Mboko, Commissioner doesn't make tax laws. The tax laws is made by Parliament, and the proposal for government policy is made by the executive, and the executive here is the National Treasury. The Commissioner's mandate is to collect taxes. So that we differentiate. I needed to clarify this because most people, when they see a law, the first person that comes into their mind is a collector. But yet, it's not the collector. The collectors, this mandate is to collect, to legislate Parliament. So we need to balance those two and get a clear understanding of the roles of the Commissioner, the roles of the executive, and the various arms of the executive. Thank you.
Thank you very much, Maurice, for that. You clarified, and I think it was one of the fears, that the VAT rate would be moving to 18%. I think that was the fear that many people had when they saw the MTRS. But when you're making the presentation, you mentioned that reviewing the rate does not necessarily mean moving to 18%, which is what we have within the other East African countries. But somehow people still feel that this 18% is coming. What is your comment on this?
Yes, let me just repeat that reviewing doesn't mean that increasing. And then the term that is confusing there is the word harmonizing with other East African partner states. Harmonizing again also doesn't mean making equal. So most East African partner states, I would say all of them have 18% rate for VAT. So and harmonizing may mean actually just harmonizing the base, or the East African partner states agree on a common rate, and it can be 18, it can be 14, it can be 10, it can be any rate. So reviewing does not mean increasing. So I believe that the public will be enlightened on that particular element, so that we don't create unnecessary fear. Yes.
Thank you for that. The other question from Clara Mchai, who says that the MTRS, with the MTRS, there'll be a review of digital services tax to make it applicable to both residents and non-residents. How does the Commissioner see this, given the discussions that happened before on the impact to local digital players? Is this something that is being considered?
Yes, the digital tax. Well, what I would say is that Kenya is in discussion with the other bodies globally, because digital tax is a global challenge, and it was introduced to address a global problem. And I would say that the discussions are already going on, and is part of our MTRS engagement. Introducing it on local players does not actually mean that the burden changes. Because and remember why we removed the digital tax on local players is because we are saying with them they are paying their taxes, and therefore digital tax creates a burden. Remember when we introduced digital tax, it was in and out, because you are going to pay but claim a credit. So it was creating just I would say, administrative burden. So it is something that is still open. We'll still look at it within the MTRS to ensure that we don't create unnecessary administrative burden or unnecessary tax burden for that matter. So, but the important thing is that we align the digital taxes with international best practice. That is the important thing. Yes.
Okay, so I see we are just getting to the final minutes of this particular webinar. So maybe Maurice, you could start with your closing remarks.
Well, first of all, let me thank everybody that has participated in this webinar. And I would like to urge the members of the public on one thing, that unless we all comply with tax payments, we'll still go back to the same problems, because an alternative to taxes is government borrowing, and government borrowing is more expensive than paying taxes. So let's not postpone a problem by giving the government leeway to borrow and not pay our taxes. We are only postponing a problem to our future generation. What I would urge is that let's all pay our equal share of taxes, and let's support the government of the day. That's what I'm saying. Thank you very much.
Thank you, Maurice. I think you mentioned something around aligning the CET rates and to the two rates that you're mentioning, and we have already 4 rates. And there's someone asking, so what happens to intermediate inputs which fall within the middle of 2 tariffs, like 10 and 25? Any thoughts around that?
Intermediate rates that fall between 10 and 25. Let me say this. Under the customs law, they are basically those rates that I mentioned: 10, 25, and 35. So the other rates that fall in between are usually created by countries when they want states. So when they want to deviate from those. But when we create certainty and ensure that the rates are only 2, we will not have rates that fall in between, because the thing is that we'll discourage issue of what we call preferential treatment. So those rates that fall within those are usually creation of the countries when they ask for a stay and say that instead of us charging 25, we charge 20. So that is what happens. So of course, he has mentioned intermediate goods. Intermediate goods are the ones that are charged at 10%. Intermediate goods are charged at 20%. Raw materials are charged at 0. Then there are a class of goods, finished goods actually, are charged at 35. That is the classification. Raw materials, intermediate, and finished goods. So
okay.
Yes, so when you look at intermediate is catered for, is a 10%.
Okay.
Finished goods are charged at 35. So we expect that probably when we have only 2 rates, which is 10 and 20, it will be on intermediate and finished goods. So intermediate will be 10%, finished goods will be 20%. Yes.
All right. Thank you very much, Maurice, for your time today. Thank you for agreeing to participate in this particular webinar. We actually learn a lot from you when you put in some time. We had quite an interesting group today, some in industry, some in professional associations, and some perhaps just in having an interest in tax, and I believe even some from the Revenue Authority. So thank you very much for allowing yourself and the team to participate in this. As a firm, we encourage everyone to continue plugging in these webinars that we organize regularly. So you can look at our page, Cliff Decker-Hoffmeyer, on our LinkedIn page, and myself, Alex Kanyi, as well, to just keep abreast of the webinars and the kind of trainings that we organize. And separate to that, of course, if you wish to be included in our mailing list for these things, please let us know, and we'll be happy to work together. So finally, to all the taxpayers who are here, again, take advantage of the tax amnesty program. I know we we are used to bashing the Revenue Authority and the National Assembly and saying it's all taxes, taxes, taxes. Please take advantage of the tax amnesty program, which I know Maurice is passionate about it. Our firm is also passionate about it because we pushed for it to be included in the bill and finally in the act. And of course, there's a limited period up to June 2024 to take advantage of that. So take advantage of that and ensure your books are clean going forward. So with that, we close this and see you in the next webinar that we'll organize. Thank you very much and goodbye.
Visions are desires that flicker between a wish and intent. They are carvings waiting for the artisan's hand. One who is consumed by purpose. One who can bring vision to fruition. Cliff Decker Hofmeyer, incorporating Kieti law from vision to fruition.